Federal Reserve Chair Jerome Powell there at a press conference in Washington, D.C., just wrapping up and walking away from the podium. This follows the Fed's decision to hold rates unchanged as expected. This comes after cutting rates for 3 consecutive meetings. The Fed hitting pause at the current target range between 1.5% and 1.75%. The Fed also signaling no move for rates through 2020. And with me now to break it all down is my co-host Myles Udland, Yahoo Finance editor-in-chief Andy Serwer, and Andy Richman, Managing Director of Fixed Income Strategies at Truist SunTrust Advisory Services. So right there at the end, Brian Chung from Yahoo Finance asking a question which I think hit on some key points that a lot of people were trying to get at, which is what's happening with wage inflation as that feeds into inflation overall. Because Powell has said he needs to see persistent and significant inflation for there to be any move.
Wage inflation. Well, or in both, right?
Or both. Yeah. And he kind of really stuck to that. And with the dot plot coming out, does it look like we're on pause here for the foreseeable future?
I mean, the dot plot suggests there'll be no moves in 2020. If any move, might be lower. There's those 4 dots that are higher. I think we've all kind of understood where the Fed wants to get to, which is a point at which they feel like it's not their fault anymore, right? And Powell he defended the decision to raise rates 4 times in 2018. He said, we believe the economy needed a more neutral setting for monetary policy. And then the question is, well, was that an explicit pushback against the tax cuts? But we don't need to go there, right? He said he's comfortable with what they did in 2018, and I think he's quite pleased with how 2019's policy path came about. But what everyone was kind of looking at in the run-up to this meeting, and we saw it again in the latest economic projections, is there's something happening in the labor market that the Fed hasn't been able to explain and Powell hasn't been able to explain, and every question was trying to get him to explain, which is basically, what is full employment? What would you consider to be full employment? What does that look like, and how hard are you going to push to get there? Because obviously, Andy, we're not there. We're not seeing wage growth reaccelerate. We continue to see unemployment 3.5%. We've been under 4% for a year and a half now, which is still below where Fed officials think the long-term neutral rate is. So I think he's going to continue to face this question until there's some more clarity on what the Fed wants to see in the labor market and how they would get there.
Yeah, and I mean, this gets back to the participation rate, and are we measuring the right things? And of course, then it can get political because depending on what side of the aisle you're on, you can point to either the unemployment rate or the participation rate to bolster your case. I think the takeaway, that I got is he said, I like where we are, right? And so the market obviously likes where we are because it didn't do anything. And if you go to mainstream media, this is not even really particularly being reported on. I know our audience cares about it a lot, and they should, because it obviously impacts the markets. But this is exactly what the markets had anticipated and wanted. There are mysteries, Myles. There will always be mysteries. Then there's the mystery of inflation. Yep. Don't get me started on that one. And, there's different signals in the economy, and I think we should have a real long debate sometime about how we measure things. But I'll stop.
I mean, he did talk about going back on some framework issues. There was a lot about inflation at 2%. And at some point, you actually feel for him. He's like, it's very challenging what we're trying to do here with inflation. I mean, it's not easy to figure out. From what you're seeing, we just wrapped this up. We're on pause here. We're talking about labor, the inflation part, also the repo market, the liquidity stuff came up. Was that important here?
I think it was important, but I think the important thing is Powell really did a pretty good job, I think, at this press conference. And he said what needed to be said. Unlike maybe if we go back a year or so when the markets were gyrating on that news here, I think what he said here was what was expected, but we heard that. And what you pointed out earlier, significant inflation and persistent. He said that at the last meeting too. The hurdle rate for an increase is very high, and we're actually seeing the bond market rally, and the 10-year's up 0.5 point on this news right now, below 180, about 178. The 2-year rallying across the board, you're seeing rates down about 4 or 5 basis points, and the odds for actually a cut have moved up a little bit. Still less than 50, but they moved up a little bit just today on that. So I think the repo market, that's a different animal, so to speak, and that's going to persist here, I think, due to some regulations, due to some T-bill buying and what's coming out there. So they're going to inject liquidity. And I think he said we're going to be there. And unlike saying where he said we were basically on autopilot last time, he's saying we'll be able to change and adjust if we need to. And that's what the market wanted to hear.
One of my favorite parts was like, you're paying too much attention to the dot plot. basically. Like, we don't need to focus on the dot plot as much as we do here.
It changes a lot, and there's non-voting members on that too.
And then the question about, well, so you need to have significant and persistent inflation. You don't think you're getting it, but you're going to have higher rates in 2 years. How do we figure out how that's going to happen? I guess they are thinking there's going to be some significant and persistent inflation, even though they can't figure out how to get it to fire.
I mean, look, I think you could look at the dot plot and say anytime PCE ticks above 2%, then they're going to raise rates, right? Because there's never been significant and persistent inflation in the last decade. There hasn't really been any over the last 20 years. There was a slight sense of that last year, and they raised rates 4 times. So, and I think it also gets back to the story, which Powell refuted, but is obviously part of the way they thought about this process, which is they wanted to get off the zero bound just because they wanted to, right? And I think it's interesting during the week when Paul Volcker passed that the Fed is still operating in the Paul Volcker setting, right?
Yeah.
They still see inflation as the boogeyman, and that's what they're most focused on. They're scared of the zero lower bound, but the reality is the economy and financial markets can handle rate increases a lot less freely than I think the Fed is appreciating.
Andy, before we let you go, he was asked, Chair Powell, what he had learned in the last year. As a market participant, what have you learned about this Fed?
I think, I do think Powell has made a little bit of a change. I think he's communicating a little better right now. So I've learned that, he wants to be more openness with it. He certainly wants to do that. But his ability to change as well. He made a change, significant change, whether he said it was a mistake or not. He made the change, cut 3 times, adding liquidity in there. So he showed his flexibility here. And from the bond market perspective, I think, again, rates for us seem low for a while here. And I think the Powell pause is here to stay.
All right, Andy Richman is Managing Director of Fixed Income Strategies at Truist SunTrust Advisory Services. Thanks so much.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.